how are we all doing? Just going to continue as we were going, really. Run through the dock screener, or maybe not actually, perhaps in this case, because my computer's been shut down, so when I've opened it up, I've had to resync all my... I've had to resync all... what do you call them? Yeah, resync, I don't know what the word is. But you can use split pane windows on Google. They go move into split tab view. So I tend to run the SEC beside Grok. So if I'm looking at its financial data, I can ask the AI some questions and open Insider to see what insider purchases are, and then Whale Wisdom side by side, so I can see what funds own it, because they're pretty similar type. The data that's shown is pretty similar. I was gonna go through the screener, but I've just seen Open Insider for the first time in a while, because generally everything stays open on my screen, so I don't tend to see the opening page unless I actually click to go on it and click on the home page, which I don't actually do. I should probably do it more often than I do, but just looking at some of the cluster buys, so I think, I don't know what counts as a cluster buy. It's obviously more than one purchase in a certain amount of time, and it'll be a short amount of time as well. 2 purchases, 4 purchases. But anyway, somebody that I'm not going to be interested in, right? A fund I'm not interested in. But I was looking at, like, Nike's had, because I don't think Nike's doing very well, is it? It's not done very well for a while. Yeah, there we go, see? It's an awful compared to where it was historically. Absolutely fallen off cliff, look. That is some collapse. 75% of its value if you'd have invested in it post-COVID. So it's just interesting to see, at least on here, that there's been 4 insiders have purchased close to $3 million worth. Now, I like seeing anything above like 300,000, but then I am generally invested in smaller companies than this. I don't actually know what the market cap is. It's not on here. Look, I am. You can adjust. You can choose what's shown on here, and I just basically go with the simplest. I just want to see the explanation of the company is what I'm trying to get at. Words are eluding me today, obviously, starting off very well. But yeah, so just going to click on this one a minute and just see 4 purchases, 500,000, $1 million and $1 million CEO, so pretty good. Are they just about to announce? They are within, well, no, they're not just about to announce. They have just announced. Okay. And I don't know if my data will actually be up to date yet. Because I think there's like some period, isn't there, before it gets released. I don't know if this is correct. I might could just be waffling. Let's just have a look at it. Hey, Nike. Thank you. 1st of the 4th. No, so that's so waffling on over nothing as usual. We all know what Nike is. Everyone knows what Nike is. Nike. I don't know. We all say Nike in the UK. Are Nike's inventory fixes boosting global profitability? So I've never looked at Nike. Might be worth doing it though, based on this insider buy-in. Although they have previously done it at much higher levels. Look, director. So he bought $1 million at 61. He's lost money on that, and he bought $3 million at 60-ish. He's only bought $1 million this time. So is he less confident, or has he just got less money to spend? You can't really read too much into that, I suppose. But it's very interesting that they were buying a significant amount up here, more than what's been bought recently. What's a blue purchase? Oh no, sorry, blue's just my... There is a key down here. Look, purchase securities on exchange or from another person. That's another thing you got to watch out for. Sometimes they sell and buy them straight off of each other, which was actually seen in one of Roaring Kitty's videos. I don't know which one, because he did like 60 odd live streams before he ended up having to go incognito. But in one of them, he figured out that a lot of insider buying wasn't actually true. It was like a stock comp buy. One of them had been given stock comp, and then the others had bought it just straight off of that person. So it wasn't actually a proper buy, even though it came up as one. So you just got to be a bit careful. But you can generally tell something like that's happened by the figures lining up, which isn't the case here. So, do I look into this or not? Because, like I said, there's 4.5 million there. Considerably higher than where we are now. It's like a 50% upside to get back to close to. Well, no, it's not a 40%. Should we pull it in or not? I can't make up my mind. I mean, you've definitely got brand identity, haven't you? Whether you haven't got a moat, though, I wouldn't say. Maybe back in the day you might have done, but Adidas. Is Adidas bigger in Europe than Nike? I feel like I tend to see more people wearing Adidas in Europe than I do Nike. I don't actually know what Adidas's footprint is in America, because this is not generally the sort of business I'm looking at. The market cap, let's see what the market cap is. Where are we? Down here. 68 billion is way above what I normally invested in. That doesn't mean that you cannot end up with huge increases, you know. Let's just pull it in, come on. Pull it in and see. Not generally the sort of thing I'd be looking at, it's way too big. But certainly some form of value, isn't there, to the Nike name? This is going to be one where, you know, like a liquidation value is going to be hard. Because the intangibles are definitely going to be worth something. Generally on the stuff that I'm looking at, you're just assigning no value to goodwill and intangibles, but it's not something you can say for Nike. So, cash flow statement, balance sheet, income statement. Let's just see what we're dealing with. For some reason, this keeps opening down here on a separate screen. Doesn't matter. Return on capital, half of what it was historically. Wow. Look at this. So I do an EBIT return on capital, which is more aligned with Joel Greenblatt and Lee Lu, wanting to know what the actual engine of the business is, so unlevered. And then I also do one from simple free cash flow afterwards as well. And it's a 50% drop in operating income margin, return on capital, sorry, and a huge decrease in simple free cash flow return on capital. You've gone from simple free cash flow 15 times earnings up to 220. When was this last? So this is out of date. This is February. Like I said that I knew that there was some sort of lag in the data. So we're looking at that there, aren't we, by the look of it? Because this date. Oh no, we're not. No, we're not. I'm waffling on, talking about shit again. Oh, come on, too far. One too far. This isn't boding well for the video, is it? Quite slow again. Let's see if I can get it. There we go. So 10Q filing date. 9 months, 28th, okay. Maybe that is correct then. Maybe my data is correct. I take that back. Do I take that back? Let's have a look. 28th. Okay. I don't know, we just go on with what we've got. EV to EBITDA, 21 times, 209 times, 220 times. Straight off the bat, not interested. Just not. Book value, $9. Tangible book value, this is where it gets difficult. There's obviously a lot of debt though, because obviously your intangibles and your goodwill's taken in your book value, so it's not making a significant, material difference. Paying more than 1 times revenue as well. Like, it would be interesting, this sort of thing, if you were paying, a significant multiple less than revenues. I'm not enamored of any of it already, to be honest. Obviously more debt than cash. Let's have a look. Balance sheet. Got one down here, look, total debt. Oh, it's come down. Doubled after COVID. Or double before COVID. We brought it down by around about $1 billion in 2 years. So this is rolling 12 months, by the way. If you're watching this for the first time. Net income significantly down. What's dragged that down then? Revenues are only down for 1.3 billion. Cost of revenue is up by about 700 million. The gross profit is out by 2 billion. No R&D expenses. Operating expenses, they're not too bad, are they? Operating expenses. Operating income. The difference has literally come from the cost of goods sold, a drop in revenue. Okay. Weighted average shares outstanding. I want to start using a diluted one. I haven't got the diluted one on here, have I? Sorry. Right. Balance sheet. To be honest, it's still better off looking at it on the SEC than looking at this. I've just got a spreadsheet up at the moment because this is a lot more condensed in the data that it brings in is a lot more condensed. You can get like some of your debts and all that, leases and everything, it will count as full on debt, when I don't necessarily agree that operating leases are true debt. So your debt can be overstated on this. It's just the way that the data does it, which is why generally it's better to read this. So let's have a look. Not doing very well on the saying no fast, have we? Are we? Because probably, I think Monish, Brian Lee was saying you got to be able to say no like immediately, like no more than 5 minutes. That's that threshold already, so we're failing that. Total current assets, around about the same 6 billion. Yeah, 6 billion in cash. Where's the debt then? Long-term debt, 7 billion. It's not too bad then. Current portion of operating lease, so I don't tend to count that. So there's 1 billion, 8 billion in true debt. True interest-bearing debt. You got 6.6 billion in cash. That has come down. Cash and short-term investments almost covers it. Accounts receivables gone up. Inventories are around about the same, so that's, what's historical inventories? Wrong one, that's my quick take spreadsheet. I've got 2 of them open. What was I looking at? Inventories. The build up of inventory there, but they're in 2023, but they are seeming to be running around a similar level. Payables are gone down as well. Net income 520 million in the quarter, 9 months. Yeah, you're $1 billion down on the 9 months. $1 billion more in cost of goods sold. As there, all your other costs over the 9 months are very, very similar. So it's literally in the cost of goods sold. Just messing it up. Where's the cash flow statement? Significantly different here, mine. Got $1 billion there. So we've lost $1 billion at the start. What else is different? Collected 450 million less. And they paid a lot more payables, paid down the payables, which I think we've seen, didn't we, in the balance sheet? Accounts payables have gone down. Yeah. Yes, there's nothing alarming here, is there? Not that I can see. Purchase the short-term investments. Addition to property, plant and equipment, so that's gone up. Maturities are short-term investments. They're obviously doing stuff with their cash, I would imagine. Maybe buying bonds with it or something, I don't know, but better than keeping it in the bank, I guess. There's nothing truly alarming here, is there? Unless I'm being very silly. I'm not interested in it, I don't think. But there's nothing alarming. You've lost your $1 billion because your cost of goods sold. You've collected less, though, I suppose. Like, is that people starting to default, maybe, on payments? That is quite, I say nothing alarming. That is something alarming, isn't it? You've lost $500 million in receivables in 9 months. Is there anything here? Let's open up the actual document. We'll have a look at the notes and see if there's an explanation for the receivables being so bad. Accounts receivable. Yeah, there you go. More than half. They're saying 600 million difference. Let's have a look down here. Notes. Stock-based compensation. Risk management revenues. Let's see. Control F. It's 147. Only 8 that get receivable. No. Said there, nothing said there. Operations, accounts receivable, decreased accounts pay, net change in working capital and other assets limit, primarily driven increase in accounts receivables. Okay, but why is that? Increase in accounts receivable primarily due to higher wholesale revenues and the timing of wholesale shipments. The decrease in accounts payable is primarily due to lower other emissions. Net change in certain working capital components, primarily driven by an increase in accounts receivable. The increase in accounts receivable were primarily due to the timing of wholesale. As they just said exactly the same thing. Repeat it twice. Look. Is that? Oh no, it's not. I thought for a minute there was word for word paragraph, identical paragraph, but timing of wholesale shipments. I don't really understand what that means. So they're selling it to people who are not paying you back yet. Their timing's changed, possibly. I mean, it's not great. What's the working capital saying? So 8 days more. On people paying. Inventory's going off the shelf slightly faster. Closer to a more historic average, look. They've paid payable slightly faster, which is now more in line with what it was historically. The cash conversion cycle, historical, what's the historical average? 99, 103, not far off, are you? I haven't seen anything to suggest that it's cheap, but fuck knows how it was so expensive, as expensive as it was. People were paying, what was it at, 100 and something? Fucking $172. That is ridiculous. People were paying like 50 times free cash flow. Meaning that if you were to purchase that business, it'd be 50 years before you saw any profit from it. And that's just on market cap, not on EV. But then they've got a significant amount of cash, haven't they? So the EV is not materially different. I don't think there's anything here that I like. I don't think there's anything here that's too alarming. I think what's happened is everybody's just gone, why the fuck are we paying 50 times? And there's just been a slow realisation after that. Right, moving on from Nike then, because I'm not interested in that. What was the other one? There was one other that I was looking at. Come on. It's going to end up being fucking slow night. There we go. Natural resources, 2 million. And this one here, loan brokers, 8.9 million on insider buy. Never even heard of these. I'm gonna have to. Oh, Jesus Christ! Not interested in that. Saying no to that straight away. What the fudge has happened here? Nope. Straight up nope. Half million. Okay, we might be going back to the MNR. $13. What's MNR? Is that when did the war on Iran start? I don't actually know. War on Iran, 2026 war, February. Okay, just seeing how that aligned with this. He had actually already started to turn around by that point. It's not done a lot since. Production of oil, natural gas, and liquids. Southern Kansas and Texas. I do actually own an oil field. I purchased it towards the end of last year. Stupidly, I haven't sold it, which I probably should have done when the oil prices were higher, because I had quite a fast 50% gain on it, and I've read Michael Burry would sell stuff fast if he'd get returns like that. And obviously, the price of oil started to come down as it's a little Brent crude. Yeah. What's that? See a historical channel somewhere. WTI is coming down as well. Look. How long until we see that at the pub? A long time, I bloody imagine. Right. Not going to be interested in that either, to be honest. So, all of this has actually not returned a lot, has it? $500,000 in a community bank, though. I used to be afraid of community banks, like regional banks, sorry, as they're called in America. I had a miss, unfortunately, but it ended up going up like 90%. And I'd done a video on it. I was like, just do a video on it. I can't remember. I was looking at something, and I'd never invested in financials before, in like specifically banks, and it was during like the post-regional banking crisis, and I was like, oh. And then all of a sudden, like, the bloody insider ended up, as I was umming and ahhing over purchasing it, because I was like learning as I was going on how to invest in banks, and I was like, do you know what? I'm quite confident in my analysis, even though it's the first time doing it. And then fucking like the day before, I was like, yeah, I think I'll buy it. Bloody insider CEO or something bought like 12 million of the stock, and then it went up like 90% the next like 2 days, and I was just like, nah, I ain't buying it now. But it was frustrating one, missing out on that one. It's probably my biggest miss of my very short and very inexperienced investing journey so far. But what I took from that was that it gave me the confidence to know that maybe I was doing the right thing. And as a value investor, you tend to find stuff early. Even if I missed out on this one, you tend to find it before the crowd does. And I suppose that was like a lesson in that for me. This has done quite well, actually. End of last year, 50% up. Have a look. CMTV. Is this going to be another regional bank that's... Oh, there's not enough in that for me. I haven't even got last year, so... Not sure. Unless it changed its name. Did it change its name? I don't know. Company's founded in 1982. Must have changed its name because I haven't got the... You normally get like a little dinosaur for when it's incorporated. And that is not on there. No, I don't know if it's changed its name or not. Nevertheless, we're not going to find out because I'm not going to search for it. So, I looked at this one, didn't I, in the last video? So we're down here. Granite resources. I've looked at these before, I reckon. Production of oil and natural gas. Oof. Why sell off? I feel like, I don't know if I've looked at this before or I've come across the name before, maybe. See what we got. GRNT. Oh, so they've released a proxy statement. This would be interesting to see, just see what the insiders own. Beneficial ownership, can we click on that? 8.4%. Not bad, not great, but fund free, whoever they are, own 50% of it. Jesus Christ. I don't tend. Do I tend to like that or not? Probably not, because they've effectively got control of the company, haven't they? So you can't. If you were to purchase, you are at the will of them. But it also shows that they have got. So look at it on here, GRNT. Also shows that they have got conviction in this trade. Going to come up or not? No. What's going on here? Not even is it working? We have to. Nothing's fucking working. Look. Let's try again. There we go. Internet's not doing very well tonight. I think that's them, is it? Don't know, 100%. What do they own? Let's have a look. 51% ownership, 42% ownership. Or can you have that? You've got so-called 4% ownership there. It's more than 100%. 4% ownership there, 2.5%, 5.6%, 42%, 51%. How's that? That makes sense. I'm being stupid, am I? 51%, 42%, so you've got 93%. Adds up to more than 100%. So that doesn't make sense, does it? Insider purchases. CEO, director, not huge amounts, but you know, it's consistent, isn't it? It's all the way through. Despite this happening. Have a look. Should have just gone back, shouldn't I? Should have just, we just had 10k as well. Balance sheet. 40 million in cash, 74 million in receivables. Oil and gas, property successful efforts method. What's successful efforts method? You don't want to waste that question on Grog. Let's just Google it. Successful effort method. Is that of accounting, is it? Is an oil and gas accounting practice where companies only capitalize costs, treat as assets directly related to discovering successful producing. Okay. Yeah, that makes sense. Accumulated depletion. So is that? I don't know. Be total property, plant, equipment net. So let's have a look. How does accumulated depletion factor into this? I take it that means that they've used a portion of it. Accumulated depletion acts as a cumulative wear and tear for your natural resource assets, specifically tracking the reduction of your oil and gas reserves as they are produced. Okay, so would that suggest that they've used almost 50% of it? What was it? Successful efforts. Efforts were 2 billion and depletion was 1 billion. Does this mean they have already extracted 50% of said oil field? Yes, accounting-wise, this is 50% of the capitalized value has been depleted. Strongly implies that roughly half the estimated economically recoverable reserves have been extracted. Okay. Learning as we're going. So, without jumping ahead, does this not suggest that it could be a dying business? How old are they? 2022. So in 4 years, because 9 on 4 years. So it's 4 years left, maybe just over 4 years left. It almost suggests that it's going to be a dying business, does it not? Granite Ridge Resources have completed almost 50% of their successful efforts. Have they any other potential future wells? Future drilling inventory and growth avenues, even if depletion under successful efforts method has risen significantly. Not necessarily how much future drilling inventory exists. So what does that mean? High depletion percentage can look alarming, but it's not a direct measure of remaining drilling locations. 137 wells were still in progress of awaiting completion. That's essentially a backlog of near-term production additions, not future exploration, but already identified and partially developed assets. So would they not be undeveloped locations added via acquisitions, bought small packages, short-cycle drilling locations? Despite depletion, proved reserves increased to up from, so it's gone up, okay, 8 million. What's that? Million barrels. That means they're replacing expanding reserves faster than depletion might suggest. Roughly 24% of reserves are still undeveloped, leaving room for future drilling. Even if depletion has approached 50%, they still have wells in progress. Progress. They are adding new undeveloped locations for acquisitions. The proved reserves are growing, not shrinking. True. Yes, that is true. Though the depletion went up almost in line with that. Where are we? This one here. There's that one. Running out of wells. It's whether they can keep sourcing attractive deals and whether returns on those new wells remain strong. Am I interested? Let's have a quick look. Let's just bang it in. Oh god, what are we doing? You can't see, but I'm just banging it in my... Oh, what's going on here? Yeah. I got a tracker that I use to keep an eye on companies, even though I'm not interested in them. I try to fill this out. Because then if I come across them again in the future, I can look it up and see this, you know. It's 496. We saw insider ownership, didn't we? I think we did, didn't we? I can't remember. It doesn't matter at the moment. Let's just fill this out. I just want to find out what the... do I need to do this? If I'm not interested, let's just do this. It's already on here. What's that happened? Just looked at it last time and then left it. Return on capital, TTM, 8.4%. Lower than what it has been historically. Tangible book value lower. Knew I'd looked at this. Price tangible book value. So I like to look at stuff that's, well, I like to look at stuff that's worth less than tangible book value ultimately, but that's around about tangible book value. Simple free cash flow is negative. Negative, always is negative as well. But that's done on a quarterly thing, so that might not necessarily be true. This is 10k though, isn't it? 296 million. Capital expenditures, yeah, so it is true. Historically always true. Apart from here. No, this is a no then, because just they're not showing CapEx is higher than earnings. CapEx is higher than earnings. Not interested. Having to borrow 162, 110, 190. Repaying it somehow, but I don't know how because their CapEx is. It's just burning cash by the look of it, so I'm not interested. What was that? Ziff Davis. Right, I've said no to that historically. Problem is, I don't know when I said no to these. Sorry, let's just put that on there. I said no to Glob, didn't I? Not interested. I think that was the last video. You started to yawn now. Did I look at this? I must have looked at this recently. Because I feel like I've come across this before. What is it? Digital media and internet company includes brands in technology. I can't remember. I'm sure I've looked at that. Manufacturing, marketing, heating, cooling, and ventilation devices. Interesting. Huge spike post-COVID. Gentherm. So look, what's it called? THRM. $28 people were purchasing it. May last year, and it's done. Well, clearly done nothing since. What's going on? Bloody adverts everywhere tonight. THRM. It's not fucking working again. Look. What is going on? Not a good look, is it? When it's all going wrong. Bloody chair's very creaky as well. Probably going to come through. 10% though. 3.3%. THRM is banging the quick take. Uh, 11% return on capital, down on what it was historically. Still above 10% now, which is why it's come off green. Tangible book value, what's the current price? 29, so too high. No downside protection for me. Earnings, well, I say there's no right. Gotta look at it two ways on how I get downside protection. Also, I say, don't I, it's top of this. So downside protection I either get from liquidation value, reproduction value, or when cash flows are really good. Man, this chair's creaky. No way that's not coming through on the video. Yeah, so I need one of these, basically. I need it to be traded less than liquidation. Michael Burry would invest in stuff if the asset value was way above, even if the business wasn't doing too well, because I'm sure one of his quotes was sometimes sheer outrageous value is enough. But if I'm doing it on cash flows, this is a Monish Babrai thing, I want it to return my money within 3 years. If not, then it's a no. So tangible book value is a proxy for liquidation. It isn't, but it's a proxy. It is less, so it's a no. It doesn't meet that liquidate. It doesn't meet like one of those downside protection things. And then earnings multiple to EVs 13 times, 17 times. So this one here is unlevered multiple. This one here is 17 times. It is simple free cash flow multiple. So no, not interested. This as well. This as well, and they're starting to sell there. This doesn't mean too much though. They could be selling it because they've got other positions that they're. They could be selling it because they found other positions that they're more interested in. So This percent of portfolio is one of the things I care about most, though, because it shows people's level of what would you call it? Not commitment. Whether or not they think it's a good idea, you know what I mean? Okay. Think of the word that I'm trying to come up with. So we're saying no to that, but we have looked at it this year. CLW, looked at this quite a bit. Oh, we're down here, look. Might be worth dragging this up. It's had a torrid time in recent years. I looked at this ages ago because they were saying that they had a gas problem at one of their plants, and that was one of the reasons for huge decline. But then ever since then, it's just kept going. CLW, let's have a look, quick take, see what we're coming up with. This bet would be worse than, yeah, there we go, way below tangible assets, $50 a share. No simple free cash flow though. Look at this, look. Good business, bad. Return on capital's return, no, positive, just. Should we look at this because of this? Trading at 30% of tangible book value. Ooh. Operating income. Look at this. What a fall off. Oh. Drag it up. Let's drag it up. CLW, paper company or something like that. Right, straight off the bat, let's see what the insiders are doing. Oh, beneficial. Oh, man. Go back up. Security of beneficial ownership. So, the sales 2.4%. Not great, is it? Not great. Let's start banging it in the tracker though. I know I started that Granite Ridge one, but I think I'm gonna fuck it off. Started writing it. What I mean is I started writing it in the tracker, but I'm gonna leave that one. Let's do CLW. Clearwater. Current price 15.27. Just drag it all in here. We're gonna look at it. Let's look at it. CLW. Let's delete these first. This is definitely changed. This menu here always used to come up down here, down the bottom, but now it's fucking popping up off the screen. Right, tangible book value of $50 has gone up as well. Gross margin's been reasonable all the time, so what's happened then? Costs, got to be costs. Debt is better than it was. I don't know what's happened here. Huge amount of cash build up maybe. Let's have a look. Yeah, huge difference in cash. Has debt changed? Gone up maybe? Long-term debt has gone up hugely as well. Around about historic levels. Well, not less than historic levels, but you know, the increase in debt is not great, is it? Depends what it's for, I suppose. So minus $5. You're looking at like fucking 11,366. You can see why the price went up. I said you can see here, I have looked at this before. I might as well delete this shit though. Not needed anymore, is it? These price levels. Areas of interest though. Right, anyway. Financials, not technicals, that's what we're here for. Let's just have a look, see if anyone owns it. Start off on the CLW, sale. That's the only thing in the last 2 years. Not great. Insiders. Anyone owning? Cool. Okay. Nobody of anything though. Toll 1.6. No, nobody. Nobody. Let's what are we dealing with? 10k recently. Balance sheet. Let's have a look. 30 million in cash, receivables gone up, inventories gone up. Is that a good thing or not? Depends on what's the historical inventory level. Here we go. Revenues. They've gone down. What's historic inventory levels? Still higher, really. Not necessarily a good thing that 1.3 billion accumulated depreciation. Okay, profit plant equipment 1 billion. Cash flow statement 12. Net earnings. So let's see what's changed. Go to the earnings to see where the cash flow statement's getting this figure from. So year on year, revenue's up. As is cost of sales significantly. SG&A though, so they brought that down. Trying to control some costs. Impairment loss. Not a huge one though. Although to be fair, it would have taken the net income positive. Interest expense down on what it was. Okay. So, increasing costs, impairment, can't see anything else there. Right, so we've got these net income, input, goodwill's back in. What's happened here then? Because depreciation's back in. 75 million pounds payable, so they've paid payables. What are the payables doing? They've dropped. Okay. Okay. It's the earnings, isn't it? That's the problem. It was to acquire property, plant and equipment. It was to acquire businesses, so they bought business. And some of it's been wrote down already. Potentially some of this business has been wrote down. So they took on extra debt for proceeds payments from business divestiture. Took on a little bit more debt, not a massive amount. That's obviously for this. I would say the majority of that, without knowing, I would guess the majority of that's for that. So it really does look like it's an earnings problem. What is the first question I normally ask? Here we go. Explain what it does. Oh, fuck off. There we go. Clearwater paper. I will finish this one up and then I'll probably end the video there for tonight. We are now 1:15 in the morning here. It's the only time I get to do stuff. Uses tissue pulp and paperboard products for consumer. Bog roll. Bum wipe, effectively. See what it comes up with, because I'll start filling this out a minute while it's doing its thing. I will start filling this out. Market cap 245 million. EV 667 million. What was the insider ownership? It was fuck all, wasn't it? We can come back to that later. What are we trying to do here? This one here. I'm just going to drag it off screen a minute while I do this copy and pasting. So, I don't even need to do that really, do I? No purchases in the last 2 years. No large fund owners. 2.55% is largest portfolio percentage. Right, done. Sometimes I will, well, not sometimes, most of the time I will just screenshot that and bang it in there and screenshot some of that in there as well. It's faster than having to write it. Right, let's see what Gross come up with. Business model. Clearwater was a premier independent manufacturer supplier. Spokane, Washington. Superior cleanliness. Okay. That's what they're saying about themselves, apparently. This is from the SEC website. Business model. Right. Non-integrated supplier manufactures paperboard but does not convert it into finished packaging. Instead it sells roll sheets to independent converters. Okay, that's good to know. As that keeps jumping off, I will have to drag this off screen a minute. I will tell you what I'm doing though. So the model emphasizes premium high grade applications where quality and performance differentiate from lower grade substitutes. Okay, that's interesting to know as well. Pricing and demand fluctuate with supply and demand. Okay, 2024 two transformative transactions to become pure play. Acquired, that's the one that we've seen there. 710 adding 600. That's this here, I'd imagine. Sold as consumer products, private label businesses, Sofidel America. Be that one then, will it? Billion. So it didn't actually cost them anything, did it? They sold one and gained one. Tissue results are now reported as discontinued operations. So they got rid of tissue and then paperboard only. Okay. Okay. That's interesting. So, consumer products, pre-2004, single operating on paperboard. Okay, so we don't need to do that then. We've only got one operating segment, revenue breakdown. Just drag this in. Can't see what I'm doing at the moment, but I'm dragging and dropping here. I've got a revenue breakdown thing here for segmental and then geography. Looks like 91% of their stuff's in the US. Not go where I wanted it to. There we go. All manufacturing assets are in the continental United States. Sales are primarily top 10 customers account for 46%. One customer is 11%. Jesus. So if you lose that, that's worth noting. You lose that customer. All manufacturing facilities, main mills, 600 tons, 90 tons, pulp. Yeah. That necessary to take in? Probably not. They've already said, haven't I, elsewhere, what they can, their type of capacity. Reposition itself as a focus scale player, right? Okay. What I want to know then is, let's just fill this stuff out a minute. Come on. Oh, fuck off. What are you doing? There we go. Cash, let's just fill this out just so I've got the data in here. 30, I'm going to say 30. Inventory 195. That's not right. Wake up 281. PP&E 1001. Current assets. Total current assets 526. Total assets. I wonder what PA was then. My bloody spreadsheet. Goodwill and intangibles 2.1. So they've written most of that off. So current liabilities 216. Long-term debt 345.5. We will add that in. Total liabilities 763. So book value, total assets 158 divided by minus 763. 158 minus 763. 825. Tangible book value is not going to be much different, is it? 825 minus 2.1. Okay. Just say 823. So, let's go to the income statement. Off up it. Statement for a start, so that's just going to close again. Revenues 1,555.4. EBIT operating income minus 42.1. So our return on capital is going to be negative, isn't it? Net income negative 18.6, and interest expense is 16.8. Right. What we will do then, simple cash flow is negative as well, isn't it? Or basically, we're going to have to figure out what's going to happen with the company. OCF 12.3. Not good. CapEx. We'll just say 89. We'll just forget the other stuff. So severely negative minus 70. We'll just say minus 77. Negative. And return on capital is negative as well. Ugh. Makes it difficult, doesn't it? This is saying it isn't. Is it because they floored some stuff? Let's have a look. We're looking at. Or a capital with 0, it's not. Not really. Even simple free cash flow, return on capital is bloody negative, isn't it? Let's find out what's happening then. COW has gone profitable. Where's EBIT generally? What was it historically? Where are we looking? Gone from. Oh god. Not even spell. Historically profitable. There we go. Historically profitable in both EBIT and free cash flow to now negative. What? That's caused, come on. That's caused the business to decline so drastically, we'll say. Is that, I don't even know how to spell it. Drastically, yep. See what if anyone's saying anything about it. Buy. When was this? 2025, mine, 2025. Probably not done very well since then. It tells you on it, doesn't it? Down 50%. And this one, down 20%. So 2 buy ratings and both lost money. Potential 25 free cash flow yield over time, 25%. And he's lost 45%. It is the story, I'm afraid. Plus 20% of workforce. Wow, targeting 8 to 12 million savings plan. Is that on here? Yes. Oh, that's not going to help, is it? To operate a Cyprus Bend facility at our production capability, expects 8 to 12 million analysed cost savings from restructuring. Maintain a hold, that's availability and timing. More events. Off we go. Trim 20% of staff. Arkansas for half production. Right, this one's a bit better. Clearwater paper will cut 20% of its staff and said facilities will operate roughly half its production capacity. 8 to 12 million. So the decision was due to supply-driven downturn in the paperboard packing industry that is weighing on cash flows and margins. While invested in cost competitive, we intend to return the mill to full production in the future. Company said it would provide severance packages, healthcare and outplacement services to employees affected by the layoffs, adding that it would work with their union through effective bargaining, or through effects bargaining. I mean, it's not nice for them, is it? But no, face of a supply-driven, what's this mean? Flash, you know what that means? What does it mean? Is it just showing a headline then? Is this the same? Yeah. So it's a headline only and only has our text. Fucking point in that. Maintain a buy. Sales up 12%, EBIT up 71% with cost cuts and new products targeting margin recovery. Right. There's indeed shift from historically positive EBIT net income and free cash flow to GAAP net losses, but the picture is nuanced when looked at adjusted operating performance. Net sales up, we know that. Operating loss, net loss, continuing operations 53 million, adjusted EBITDA under 7 million, cash from operations 12 million, capex 89 million. Right, anyway. Telling me stuff we already know. It was modestly positive, but free cash flow already negative due to integration capex. A large overall net income was driven by 307 million pre-tax gain on tissue divestiture. Discontinued operation. Large overall net income. Negative though, isn't it? Or is this not up to date? It has to be, yeah, 2025 full year. That was last year. Oh, I see what he's saying. A significant portion of that net income came from something else. GAAP net loss in 2025 is heavily distorted by 48 million non-cash. Yeah, I said that. I pointed that out already. Excluding that and other adjustments, underlying operations improved significantly on an EBITDA basis due to cost cuts and volume. However, free cash flow turned structurally negative due to elevated capex and weak conversion downs. This is why I know people use EBITDA. I know Michael Burry uses it, I think, purely for screening, but there's no capex in EBITDA. And then all of a sudden you add capex in and it's negative. Primary cause of the primary cause of the decline. The business has not collapsed operationally. Adjusted EBITDA more than tripled. Progressive cost actions, but is now fully exposed to severe prolonged downturn. Industry-wide oversupply and pricing collapse. Oversupply, that's not good, is it? Ooh. It's got to go in the tracker, in it. Industry-wide oversupply. I've got a risks thing, so that's going in there. Fully exposed to severe prolonged industry-wide oversupply. Classic down cycle supply has outpaced demand with industry operating rates to low to mid 8% versus a healthy exasperating oversupply, so everybody they're fucking themselves over effectively. Averaging net sales fell. That's why they're dropping the capacity, but you needed that to happen industry wide. Average net selling prices fell because there's an oversupply, I'm guessing. Signal for 2026 volumes rose 14%, but erosion more than offset the benefit. Management state current margins cannot sustain long-term investments in capital-intensive assets and expects recovery only in the medium term via demand growth, lower import tariffs. Oh dear. Let's take that. Put that in my risks column. Doesn't sound good, does it? Cost and operational factors, positive. 50 million fixed cost savings, okay. Lower but negative. Elevated capex from maintenance integration plus one-off weather disruptions early 2026. Goodwill impairment triggered by market cap decline relative to post-divestiture book value. Broader context, paperboard demand is tied to consumer packaging, which has been soft amid economic uncertainty. That's got to go in as well in the risks. Pre-transformative, mass paperboard weakness, management outlook and mitigation. Use this as temporary, defending market share, launching new products and targeting cross-cycle adjusted EBITDA margins 13 to 40% with 100 million annual free cash flow once utilization. What timescale are they putting on this then? Because obviously that's a hell of a turnaround. What timescale are COW putting on this free cash flow normalization? I mean, I'm a value investor, right? So I'm looking at like 3 years minimum. You know. So it could look cheap. Could look cheap, I guess. What are they saying? 100 million with 100 million plus annual free cash flow once utilization normalizes. What's the current market cap? 245 million. So they reckon you can get 100 million. You buy the company out in less than 3 years. Ooh. Starts to potentially look interesting then, doesn't it? Come on. Hurry up. Given a time frame. Does not provide a specific year-by-year timeline for normalization, sustainably positive and reaching their cross-cycle target of 100 million annually. Instead, management consistently frames expectation around medium-term industry recovery leading to normalized performance. Exact timing is unpredictable. Current industry oversupply and resulting operating rates are leading to margins that cannot sustain long-term investments in our industry's capital-intensive assets. We believe that the combination of demand growth, lower imports, and change in domestic supply will lead to recovery in the medium term and put us on a path towards cross-cycle margins. How do you know it's going to be lower imports? Like cross-cycle targets. Stated long-term goals. So, contrast with the current down cycle. So revenue is going to be around about the same. CapEx is 65 to 75. What is it? Here. 88. So they're making cost savings. Focus remains on cost discipline, productivity, and offsetting inflation. No free cash flow positivity. 100+ million is guided for 2026. Management has repeatedly stated they can't predict the timing of an industry recovery. No, I get that. The paperboard sector is highly cyclical, driven by supply-demand imbalances and recent capacity additions. Their base case assumes gradual improvement via external factors, but they avoid committing to 2027, 2028, or any specific year. So they see this as a long-term problem, effectively. Capital short-term still focus on deleveraging, cost reductions, and maintaining liquidity. What's their debt? Long-term debt, 345 million, went up. Potentially due to that acquisition. It's expected to remain pressured, recovery to cross-cycle levels. This is an explicit horizon, they reference for normalization. Medium term, that's all they said. Capital allocation priorities, once free cash flow improves, delevering to 1 to 2 times net debt. Once free cash flow improves, deleveraging. This messaging has been consistent in November. Next up, they will come Q1 2026, scheduled for next week. Next. It's 1:30 in the morning, next Tuesday, for the absolute latest check. What we do then, what we will do is circle back to this next week. We will try and circle back to this next week. This is a difficult one, isn't it? Because there is significant asset upside. You could buy the business, shut it today. Maybe come out of a profit, because liquidation value is difficult, and you're going to be selling something at like highly specialized, so I don't know really. Is there any downside protection? Because their property, plant and equipment is majority of it, isn't it? Balance sheet, PP&E, yeah. Total assets of 1.5 billion, most of it's PP&E, which is highly specialized. So look, what would TOW expect to get in liquidation? What are we going to say? Or because the majority of its inventories and PP and E. Percentage wise, because we can work it out ourselves, trying to speed it up. If you look here, like you've got 1 billion in PP&E and 300 million in, around about 300 million in inventories, 30 million in cash. So the majority of this is inventories and PP&E. Industry benchmarks set 10%. So is there any downside protection at all? Let's see what it comes up with. I reckon 80% for the inventory, so that's not bad. This can go in the notes as well. Paper industry might recover 40% in liquidation, depending on finished paperboard could fetch 60 to 85% of book value in liquidation. So it's going for a lot of different going on here? You got any bonds while we're waiting? Clearwater. Yes, they do, and they are maturity 2023 is gone, 2028, so that's the ones there. Trading at, that one's 105. Clear, that's because it's different companies, so we got two there. Trading at 89 and 90. It's not great considering you're 2 years out, but it's not bad. Not bad, is it? And 10% yield mine on that bond. 10% yield. On this current purchase price size. Right, anyway, where were we? I want you to, as the AI, to tell me. Property, plant, and equipment, 80% of gross. Appreciate a straight line. Fuck off, just where's the... You've gone way above what I was expecting. Rough illustrative liquidation value. Jesus. Combined 200, so there is no before selling cost taxes or environmental liabilities. They're saying there is no liquidation value. Doesn't mean you got to liquidate it, mine, they could sell it. Better range in liquidation, 50 to 75 book value. Oh, yeah, that's the inventories, PP&E. It's highly specialised, see, that's the problem. Lender benchmarks, industrial site, 23% net of net book. Conservative rule of thumb. Actual chapter 7 liquidation data across manufacturers shows PP&E recovering around 35% of book, but ranging 88 to 69% of capital intensive sectors. Oh, that's a wide range. 350 million. What are they saying? 60% of that. So 200 million. Just aligning with this. 560 million. 763 million of that. What else is there? Got here, long-term debt. That's the big one. Accounts payable and accrued liabilities. Okay. So potentially no downside protection, but it's probably a business that would sell to someone else, so basically then we need to have a come back next week on this one. Where is it here? See what they say the update is to do with their any recovery. Alright, hang on, how do I do this? Look for, hang on, I'm not writing this on screen so you haven't got a clue what I'm doing. Look for any recovery, see what I'm writing, think straight up it. Recovery time period in the next, what was it, release? 28th April 2026, as they have been stating, they have a medium term goal of 100 million free cash flow annually. This would be a 2.8 times market cap Multiple. Problem is, you've got debt, haven't they? I don't tend to do it on the market cap. Yeah. 6.6 times EV. Where's that? 6.6 times EV. I had to see what they say. I'm a no on this currently. I know it's in a cyclical downtrend, won't last. If they're only saying that they reckon recovery range is 100 million, and this, 7 times EV in a difficult industry. Oh, I don't know. I don't know on this. When I looked at it before, I thought I sort of liked it, but now, I mean, to be fair, when I looked at it before, I didn't have the knowledge that I have now. Not that I have a lot of knowledge, but I'm more knowledgeable now because you're learning as you go. Don't know what to make of this one, to be honest. There's no point doing any discounted cash flow because the business has changed from here. So there's no point using these margins because the business changed at this point. What were they earning before if they broke it down? 10k, statement of operations. I need it broken down. Let's have a look. I need to go to bed. It's like fucking 20 to 2 now. Jesus Christ. Where are we? Oops, where's revenues? I want a breakdown of the revenues. Discontinued operations. Not going to tell us, is it? Right. Anyway, I'm going to leave it there. I will try and look this up off screen, but we're going to come back to it in a week later. In a week's time anyway, we can cover it then. But at 20 to 2 in the morning, I would imagine my 6-month-old will probably be waking up for a nappy change in about an hour, so I'm going to be absolutely knackered tomorrow. So it's a good thing I don't have to go to work tomorrow. Thank you very much. Please like and subscribe, even though apparently I should be saying that at the beginning of the video. I messed up again there, didn't I? Anyway, thank you very much. Learned some things today, hopefully, and we'll try and come back to this one, see what's in this next, is it conference call or is it Q1 update? Okay, Q1. All right, thank you very much. Goodbye, and I'll see you on the next one.